Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Thank you for listening to Stocktake, the podcast from Intelligent Investor. For a free trial, visit intelligentinvestor.com.au. Good morning, everybody. My name's John Addis. I'm the founder and editor of Intelligent Investor. And this morning I have with me here Nick and Angus, who are going to talk about Google. We made a big recommendation last week. We decided to sell Google from our funds and our portfolios. And we're going to start to explain why by dipping back into the distant past when people used to catch taxis. Now, I think we should remind listeners how bad taxis were. And I think the best place to start is with Angus, who can tell us his worst Sydney cab story.
Mine's not in Australia. I was in Jordan. Yeah.
Jordan?
Yeah. And I had a taxi driver. I sort of got in this taxi. The guy seemed really friendly, and then he stopped for cigarettes. And I was like, well, this is a bit weird because he's in the shop and he's having a chat, and then he brings someone out to have a look at me, and I'm like, oh, okay. And then I sort of knew loosely. I knew the city a little bit. I was in Amman, and I'm like, oh, well, hang on. This isn't the quickest way to be going. Where are we going? Anyway, we get there, and then he tried to charge me about 100 times what the fare should have cost. And I'm arguing, going, no, I know. And, my Arabic sucks. And I'm trying to say, no, I
Same
know.
Here, Angus.
I know
Arabic.
what this should have cost. And then a shopkeeper came and got involved because I'd come to this little tourist area. There's a Roman amphitheater in the middle of the city. And I'd gone to there, and this shopkeeper got involved. Anyway, next thing the police are there, and I'm in a police station in Amman. And this poor bloke came with his whole extended family. And I mean, it wasn't good what he had done, but it was one of those situations where he was facing very serious criminal consequences for this situation. And I had just, and at the end of the day, it was quite a lot of money even by Australian standards, but these things happen when you travel. And that's one of the things with taxis, right? You never quite know where the driver's taking you and how much you should be paying, because even the meters, how often taxi drivers, they don't even put it on the meter.
Yep.
And it was one of those things. I backed down the whole situation, was just like, look, don't worry about it. Let's just, make it even. But it was one of the worst experiences I've ever had traveling. And I think a lesson from it was to be very careful before you let someone else kind of grind their axe with the authorities on your behalf in a foreign country.
Okay, well, you guys didn't deliver what I was hoping for there. I was wanting Sydney-based stories, so I'm going to have to sort of clean your act up by telling you mine. I just got a cab once I think it was from the city to Bondi Junction. We used to have an office in Bondi Junction. And I don't know what the cab was. I mean, obviously I knew the way, but he broke down halfway. He broke down in Woollahra. And I said, and he asked me, and I said, okay, I'll get out and get a cab the rest of the way. He goes, well, what about my fare? And I said, what do you mean? And he said, well, you should give me half the money, like the money that's on the meter now. And I said, mate, I'm paying you to get from A to B, not like A to sort of A and a half. So we had this massive row over it. It was only like $10, but it was the kind of principle of it. And at that point, I decided that, Sydney cabs were just terrible. And I wrote a story for the Sydney Morning Herald called Killing the Cab Charge Dinosaur, which is almost 10 years ago now, and explained how cab fares in Sydney were just ridiculously high. They were some of the highest fares in the world, and most of that money was going to the people who issued the licenses and the people who did the deliveries, which is a company called Cab Charge, run by a guy called Reg Commode, who sort of used to have this golden toilet where he could put his hand into it and pull out loads of money, thanks to the New South Wales Labor Party politicians who would restrict the number of licenses. And Cab Charge faced this moment when Uber started, who behaved illegally. They were just driving around without licenses. And you could see this massive transformation. And I saw this in the story. It became one of the most popular stories on the site. Everybody hated cabs. And we just saw this massive switch from cab charge and taxis to Uber. and just the wonders of that app, it felt like a transformational experience. And the reason why we're telling this story is because it was an example of what Clay Christensen calls the innovator's dilemma. So, Nick, it is important to understand when you're thinking about Google. It's important to understand when you're thinking about any technology company, which is why we're going to focus on this framework for the rest of the podcast. Can you explain what the innovator's dilemma is, please?
Well, the way I think about it as an investor, it is when an incumbent is faced with a disruptive threat and the incumbent is forced to compete against its own existing business model to, I guess, fend off that threat. And why it's so hard for companies or incumbents to do is because it means giving away the cash flows of today for the uncertain promise of cash flows of the future. And that's really, really hard to do. And when we think about, I guess, management and also the just general investor community, no one wants to do this. Management's pay is tied to how the business performs, next year and this year. And investors, they hate uncertainty. So the first thing they'll do if a company tries to disrupt itself is it introduces uncertainty, so they'll sell the stock off. Management gets under pressure. There's a lot of career risk. So that's why a lot of companies fail when it comes to the innovator's dilemma, because they don't want to disrupt themselves. They're so hesitant to do it. And it's because the future's uncertain and they don't want to give away those cash flows of today.
Right. And that's the dilemma. And you can see that with Blockbuster, the video chain, when it faced a threat from Netflix. We saw it with Spotify and record stores. We saw it with Fairfax, now Nine, which owns, Australia's major city-based newspapers, when it fought classified threats from REA and car sales and businesses like that. Angus, how does this relate back to the taxi industry? What was the innovator's dilemma for cab charge, and how was Uber so successful so quickly?
It was just an enormous kind of undercutting in the business model. It was presenting a superior product at a lower price in a far more a far more transparent and pleasant experience for the consumer. It was just a kind of the whole thing that people suffered from taxis for such a long time, and suddenly you had a product that was just orders of magnitude better. And I think it's really just a story of somebody coming in with something that's better and that they can do, and that's cheaper. And usually when that happens to a big business, a monolithic business that's been in its position of authority and position of high profit margins for a long time, they really struggle to kind of adapt and address that competitive threat.
And there's also an argument to not respond at all. I think that businesses tend to have a fixed kind of lifespan. I think you don't know when that moment will be. But there's a big incentive for managers just to hang on, even when they're faced with this dilemma, and try and create a future that might not exist for them. Nick, do you feel that Google is in that moment right now?
Yeah, I think they are. And just addressing your point on businesses with fixed lifespans, I mean, you can see that in the data around the S&P 500. If you look at it, companies 100 years ago tended to have a far longer lifespan than they do today. I think it's maybe like under 25 years. Don't quote me on that, but it's a lot shorter than it used to be. So change is happening rapidly, and it'd be almost negligent not to think it can't happen to a massive business like Google. And they do face the innovator's dilemma today. They're being attacked from multiple angles with large language models that are rolling out, that are using AI to provide a better experience in some respects than their traditional search engine. And Google are, experimenting and integrating their own AI as well, but it's a huge risk to the business. The other way to think about it is forget about AI for a second. The other part of the innovator's dilemma is when a business reaches maturity. And I think Google is reaching maturity. So they already take 40 cents out of every digital advertising dollar spent. Digital advertising dollars are 3/4 of all advertising dollars. And if you say, think about 5 years ago, is Google's moat bigger today than it was 5 years ago? And I would argue that it's not, or at best it's stable. It's certainly not growing. So I think this business, regardless of AI, is particularly in search, is hitting that maturity stage. And this is the classic sort of diagram that's rolled out, I think, in the Innovator's Dilemma in that book you spoke about, John, is when the first S curve hits the second S curve, and that second S curve is obviously AI. But when that first S curve hits maturity, and I think we're approaching that stage potentially for Google.
Yeah. Now, we first recommended this company. Well, we didn't recommend it. We said investors should hold it in April 23. Since then, the price is up almost 50%. And we have reversed our position on what we thought. I think we reiterated that recommendation about a year ago. After the break, we're going to get Angus to explain what's changed in the past 12 months. Stay with us.
Feeling overwhelmed by market noise? With all the recent headlines, it's understandable. Join Tom Wilson, investor educator and product specialist at InvestSmart, for a free webinar on Tuesday, April 8 at 1 p.m. He'll walk you through smart strategies for tuning out the noise and navigating market volatility. You'll learn how to build and stick to a plan even when markets dip, the behavioral traps to watch out for, and why regular investing beats emotional decision making. Don't let uncertainty hold you back. Register now to join the live session or sign up to receive the recording later. Visit investsmart.com.au/events.
Okay, we're back. And to discuss Google and what's changed in the past 12 months, Angus, tell us what's going on. Why is Google facing the innovator's dilemma in a way that it wasn't a year ago? What's changed?
It's really been an exponentially moving technology threat. The competition, ChatGPT launched, and I think at the time Google was caught flat-footed by that, and that was a couple of years ago now. And at the time, ChatGPT could kind of do you cute poetry. There is now a whole host of competitors, and they're producing these chatbot products that give you superior results for most queries than Google. So Google, for certain queries, remains the best, and I think it will stay the best for a long time, which again kind of compounds into that innovator's dilemma thing. It's still going to have a good business in certain respects, but its problem is that these competitors they're cheaper to operate by a very large percentage. And now they're open source. So now anyone can kind of be spinning up a product that is superior for many queries. So Google a year ago, frankly, I actually think even a couple of months ago, its search engine was so far superior to anything else. Like if you tried to use Bing, if you got a new computer, a PC, and Bing was the preloaded default, within a day you were usually switching across. As a little experiment about a week ago, I switched to Bing, and Bing now has all these OpenAI integrations. It is a vastly better product than it was. But you've got Apple's got its Apple Intelligence. You've got all these other giant tech companies, and then complete upstarts who now can spin up DeepSeek for free. And I think it's interesting where DeepSeek to do a Google search, it costs that business about 1 to 2 cents. To do a query on DeepSeek, it costs DeepSeek about 0.005 of a cent. And, I would challenge anyone to kind of show me a single time in history where a company has beaten a competitor that's brought in a superior product that they can produce at 1/100th of the cost. Right. And so I think that's where we're at.
I think that's right. If you think back to the cab analogy, when Uber came along, the big difference in the pricing wasn't just the user experience. It was also the fact that you didn't need to have a license. You weren't paying an entry cost to get into that marketplace. And they were a network. They provided the software and people just got onto the network. It's a massive change in the cost base that delivered an improved user experience. And I don't know about you guys, but I use ChatGPT 90% of the time now. I rarely use Google. I find it really good for research purposes. I think the writing is terrible, but it's obviously improving. You have to check everything, but in terms of checking on your thinking and finding out interesting stuff, it's really, really good. It's a vastly better user experience. And the fact that it doesn't have ads at all, and OpenAI is committed to not having ads, although I don't know whether that's going to hold, to be honest. Surely not. Somebody's got to do ads. Somebody has to do ads. But that's when the cost base advantage really comes in. You grow your user base now, and a lot of these companies have hundreds of millions of users now. And it's just a very, very difficult thing to respond to. And you can see that in Google's response, where they have the Gemini sort of synopsis at the top of the page. Then you have the links. And then if it's a shopping-based query, you see the shopping. It's really, really ugly. And you can see in how they're responding, how they're struggling with this dilemma. So where do you think Google goes after this, Nick? What do you think the path they're going to take? Because they've got probably one of the best businesses in the world. Search is an incredibly high margin business. It's being undercut with a product that I think is better and cheaper. How do they respond, do you think? What do you think they should do?
Well, yeah, I might start off by giving you the bull case and then the options to for their response. But I guess the bull case here from Google is this isn't Blockbuster and Netflix in the sense that Blockbuster had no idea and didn't know what streaming was. Google and Alphabet have been using AI for years, and even ChatGPT was based off a lot of Google's own research. So this is a company that does have actually fairly decent AI products and has been integrating them into more and more products. And the other big advantage Google has is distribution. And this is something that no one else can replicate. So they've got, I think, Gus, you might be able to correct me, but 9 products with over 1 billion users. So think like Gmail, Maps, YouTube. So they're seeing AI across multiple different products and how it's influencing those interactions with consumers, and they can use that traffic then to also funnel people back to Gemini and Google Search. So they have got a distribution advantage, and that still holds today. They also have an infrastructure advantage to an extent where they own their own cloud computing platform. A lot of the large language models, I know OpenAI is partly owned by Microsoft, but they actually are reliant on other cloud computing platforms, and that's why you see capacity restraints on a lot of their products. And finally, they have a lot of financial firepower, so they can spend tens of billions of dollars attacking this problem. So Google has a lot of things going for it as well. I don't think we should dismiss them easily. In terms of the options they can take from here, I think the usual option Google has taken is off the table, which is buy the competition. So they did this with Google Videos when it was competing against YouTube. They just bought YouTube. They bought DoubleClick. They bought Android. So that is now off the table because there is so much money and there's so many startups. It's so that option's off the table. The second option is to do what I think they're going to do, and what they're doing now is integrate Gemini more and more into search. So you've seen that with AI Overview. Hope monetization doesn't fall too much and that the product is good enough that user habits don't really change. Or if they do change, they're mainly going to ChatGPT for productivity, like writing, coding, or just answering a basic query rather than a query with commercial intent. And so if they can do that, that they might be able to scrape through and then eventually integrate, a chat bot alongside inside search as well. So I think that's the path that they're going to take. The last option is the nuclear option, which is essentially competing against themselves. And I think the best way and the only way that Google can do this is to leave Google Search as it is and then spin off a separate unit that is a large language model, maybe within DeepMind or Google Brain, and that is designed at disrupting Google Search business and really competing with these ChatGPT and those companies. I think it has to be separate because if it's internal management, will probably favour the business that's bringing revenue and profits with resources. So I think it sort of has to be a separate unit. So I think that's their options. I think they'll go with the safe option of just trying to make Google Search good enough to keep their current user base and traffic.
Yeah, and I think that was illustrated. That dilemma was illustrated in 2021 when an internal team in the search business offered a ChatGPT-like interface, and management basically said, "What do you think? What the hell do you think you're doing? It's going to destroy our business." And they canned it, and now they find that the competition have done the same thing using Google's research, and they're back where they were 4 years ago, except for the fact that now there are tens, if not hundreds, of people competing with their business when they had it all to themselves. So, Angus, what's your view on this? What do you think Alphabet should do in this situation?
Yeah, I think it's tricky. I think there's no question that they are, they're almost like the muscle tissue of the internet. They have their hands into so many of the fence palings and the gateposts of the internet that it's really kind of going to be very hard to dislodge them. But I do think one of the things I kind of think about with this is you've usually had tipping points in technology. It's not a linear move. Things don't move incrementally. They kind of slide. And when you look at kind of some of the scale that some of the apps are achieving, that some of the competitors, you could see a sort of deterioration quite quickly. And the way that Google reports its profit is different to a lot of other companies. It bundles a lot of stuff into its profit reporting. So
I'm amazed the SEC lets them get away with that. It's incredible.
I feel there's quite a few things when you look at Google and you kind of see a business that has it's ruled the roost for such a long time that it's sort of, it hasn't been questioned. So basically, advertising and search are all bundled in, and it's services thing. So it's SaaS products. It's all bundled into one thing that's like 107% of profit. And then there's a few little loss-making things, and they break out cloud, and then the rest. So you don't really know. It's very hard to actually detect from their financial statements whether there's any decay or not in the profit, in that core search profit. And what I really didn't like was they recently made this acquisition, and I know that it's what they bought is a cybersecurity company. It's growing very fast, but when you look at it, for the first time ever, Google has got legitimate competition. And the last thing that I think management should be doing is encouraging users to go and trial other platforms. The company that they've bought has spun out of Israeli military intelligence, which means that they're now exposing themselves to boycotts for, a fairly large portion of the world. 25% of the world is Muslim. That's given China can't access Google. That's probably, say, a third of their addressable market. And there's been attempts to boycott Google in the past, but they failed because the product was just so far superior. But now you've got a product that is not as dominant, and management, the cybersecurity product is for their cloud, as far as you can sort of tell from what they're trying to do. Maybe it's a great move on its cloud, but cloud is a very small portion of profit. It was loss-making until last year. So I just think when you look at what the management are doing, it doesn't appear like they're taking the threat very seriously. That's sort of my read on it. And when search is such a gigantic component of the business, perhaps 80 or 90% of profit, it's a big risk.
I would just like to add to Nick's presentation or counteract Nick's presentation with the bear case. Like, the user behavior online is quite hard to shift, and we've all been acclimatized to just going to Google to search through the search bar for years now, maybe decades, over a decade. That is, for a lot of people, that is perfectly good for them, and they may well stay doing that. So I think that's one thing to consider. The second thing to consider is the margins in this business are still exceptional. And even if the competition cuts the margins and produces better app products, this could still be a reasonable business. The problem is in the valuation and the fact that the company is so reliant on the search business and the margins are so good that you can still do your dough without Google really failing. And this was a case with taxi medallions in New York, which is a point that you made, Angus, about how the valuation has fallen from $1 million down to 100,000 since the launch of Uber after it reached that sort of critical presence in the marketplace. I'm not saying that could happen with Alphabet, but it's a possibility. And the fact is that a shareholder, you don't have to make the horrible choices that Google's management has to make. So, Nick, is that why we sold out, so that we didn't have to take that choice and face that risk?
Yeah, I think so. The innovator's dilemma is really interesting because it's also the investor's dilemma, and that's what we face today. You can really paint an argument, as I had, why Google's still an attractive investment today. It's probably on, I think it's 15 times earnings for FY 2026. You've got YouTube in there that's growing amazingly well. It's a now bigger business than Netflix. You've got Google Cloud that is a distant third behind Amazon and Microsoft, but that's a business that's growing at 30%. So there's other units to like. You can probably ascribe some value to Waymo, their autonomous vehicles business. So there's things to like. But as we've also discussed, if search is the vast majority of their profits, which it is, and it's under threat, these businesses might not be able to grow enough to really support that valuation. And there's a world where, as I said, Google scrapes through and the current valuation looks attractive, but there's also a world where this is newspapers and it's a slow decline each year, and more and more commercial queries, which is really what we're talking about in terms of their income statements, their financial statements, is more and more commercial queries start to be done on ChatGPT because user behavior starts to change. And I think that's the real threat. So it's really, it's an absolute dilemma. And I think, as you said, John, we don't need to take the risk. We can sit back and watch how this plays out from the sidelines. What I do think is probably a permanent change is that Google's multiple, I don't think is going to go back to 30 times. No. I think that multiple of earnings that people are willing to pay is sort of permanently impaired, and you'll need earnings growth from here to get attractive returns. And I think we just don't need to take that risk, which is part of the reason why we switched to sell.
Yeah. Gus, you want to add anything to that?
No, I mean, I think Nick just summed it up perfectly. It's a really hard choice to make, and there's an element of you're competing with some amount of groupthink in that it's when you look at broader history, people in systems of kind of power and dominance, it's been very, very hard to see an alternative, and people have usually been really surprised. And Google has been a dominant part of our lives, and it is the dominant kind of core of the internet. But I think, there's other gatekeepers to the internet as well. And one of the things that I think about quite often with Google is, there's about 1 billion people using Apple devices, maybe 1.5 billion. And Google pays a very large share of the revenue it generates over the Safari, the Apple web browser. It pays that to Apple to ensure that it's kind of the default search. Apple has its own AI products. Apple has never shown itself to be compassionate for the companies it works alongside for a long time. If Apple terminates that relationship, I think, I don't think Google's price will move with the fundamentals. I think you could see, this could be a real kind of flashpoint for AI panic if that kind of does set in. It might not. It might already be happening. It's very hard to say. And you don't want to throw the baby out with the bathwater and get too excited. You can see, I think there is a similarity here to Meta when it was getting over its skates with virtual reality investment, and when Apple cut it out of its ecosystem, out of its advertising. It cut cookies out. Or I forget what they pixels.
Yeah, it was app tracking transparency. Apple.
Yeah, and people got really bearish on Meta. The stock price came way back, and then it's absolutely exploded since. But I think that the difference here is Google's business model is fundamentally about people asking the company questions and it replying with advertisements. And now you have an alternative where you can ask questions and you're not getting anything thrown at you. No one's trying to sell you anything. And I think when you look at other technology products, the ad-based version is normally at a discount to the premium version is the one without ads. Now you have a free product that gives you that premium experience. And I think that is going to be an interesting thing to watch unfold. And I think from the sidelines is probably a better place to see it happen.
Yeah, and I think also when you look at the monthly active users on all the competitive products, you've got potentially over 1 billion people there, I would have thought, who are using potentially competitive products. I'd expect some of them to try an ad-based model. And the fact that they're doing it and they've already established a user base with hundreds of millions of users means that you're probably going to see Google face margin pressure. And I think that might already be expressed in the multiple, but that's the thing that the company faces. The difference, I think, with the parallel you mentioned there with Meta was that Meta had a way out. Meta's way out was to use artificial intelligence to basically track or to profile users rather than just use the Facebook pixel that used to travel around with you on the internet. The path out of this for Alphabet is probably maintain your search business, but a lot lower margins, and that's the thing that they face, I think, initially.
I think just one other point is just that the speed that this is moving at, and Apple is a business. Alphabet is a business that is at the absolute cold front of this extremely dynamic situation. And just today, I was reading there's a Singapore commentator that I was reading this morning, and he's just spent some time in China, and he was talking about the leading technologies that like really blew him away in his time in China. And his number one was the integration of Baidu, which is China's Google, with DeepSeek, and the integration into their maps. And so now there's apparently this incredible ecosystem in China where you can be using, you could be asking, where should I get noodles near me? And you've got an AI agent actually having a conversation with you and looking at all the places in the area, then showing it to you on a map. At the moment, we don't have that functionality in the West. And I think one of the things to think about with a lot of the things that Google has as moats, such as Google Maps and such as the superior experience you get when you search something and it shows you where the nearby business is, that part of the technology is the easiest part to solve. Integrating map software into an AI is it's not a simple thing to do, but it's not the hardest challenge. And I think a lot of the things that Google has kind of, where its moat looks the strongest may not actually look that strong, and it's moving so fast against it.
Yeah. So this is the thing about the innovator's dilemma, and the sort of questions it poses, not just to the company that's subject to it, but also to shareholders in these businesses. You need to be careful when there are fundamental shifts in how a business operates in its competitive marketplaces. This is just getting a lot more competitive for Google, and it's very hard for them to respond in a way that isn't going to cost them margin. So I think we'll end it there. Thank you both for your time. Thanks for listening, and we'll be back with you in 2 weeks.